So glad you are back with us on Everything They Never Told You. Brad Johansen with Joe Wirbick, President, CFP, Sequinox Wealth Management. Nice to be back with you.
Great to be here with you, Brad. Always enjoy it. We always have fun.
I mean, this is fun.
It is. I like talking about the economy, taxes, stock markets, stuff that most people just don't care about. I geek out over every single day, and sharing it with you is always a blast.
Well, yeah, you geeked out. I want to give this to you too. I want to put up the book because he continues to give stuff away for free. Look, this half hour is giving stuff away for free, but it is all within the book. Everything They Never Told You About Retirement. Scan the QR code. How much is that going to cost me? He'll give it away for free. He'll send it to you for free. And we're going to talk about stuff that's in this book, but we're going to talk about stuff that the government is moving for. We've talked a lot about how volatile 2025 was.
It was a volatile year.
And yet positive.
Yeah, I mean, the S&P up 16%, the Dow up 17%, the NASDAQ up, the Dow was up 13%, the NASDAQ was 17%. It was a great year for all three indices, even though we had that volatility. We had the tariff debacle at the beginning. Markets were down 15, 20%, but we still came back.
So the worry is, since we've had this great run, and for most people, if you've been in the market, it's been for the most part a run of 15 years. Save a year or two here. So people say, okay, here we are destined for history. We go back to 1929. Is 2026 1929? Your initial thoughts on 2026?
I'm glad you brought that up. You know, the first thing you said was we've had this epic run in the market. And so because the market's so high, it has to come crashing down. I hear that. Well, it's so high, it can't go higher. Of course it can. Of course it can. Stock markets never crash because they're high. Stock markets crash because there's something fundamentally wrong inside the economy. Something is broken. 2008, for example, our last true bear market, from September of 2007 to March of 2009, the stock market fell over 55%. We're talking about, 2 years of just devastation because the housing market was completely upside down. It was underwater. They were giving loans away. It was a massive problem inside the economy, and the market responded. The blips we've seen, these, I call them V's in the market, those are more black swan events. Those are more short term because I think this economy is very strong right now. I think it's strong. I think 2026 is going to look good. And there's a lot of reasons why. One of them I want to talk about, we got the new Fed chairman coming on here in 2026.
Okay, uncertainty. We're going to have a new Fed chair. We've had interest rates where if you took advantage of them, and we talk about this all the time, if you want to refinance your retirement, in the last couple of years, refinancing phenomenal.
And the opportunity is still not gone. You still have a great opportunities to lock in some very strong risk-free returns.
Okay, let's talk about that right now before we get to Fed. And I guess it's getting to a new Fed chair.
Part of it.
That will tell us what should we be taking advantage of before we hit a new Fed chair.
Well, what does the new Fed chair mean for interest rates? We have two top runners right now. They're both Kevins. We got Kevin Hassett and Kevin Warsh. These two were handpicked by Trump because
they will lower rates.
They are expected to continue to lower interest rates, which is kind of a seesaw effect. Lower interest rates are not good for everybody. They aren't. Lower interest rates are really good for borrowers, people who want to borrow money. Who wants to borrow money? Businesses.
Yeah.
Businesses are the biggest borrowers of money. And so when you tell a business, hey, we're going to lower interest rates by 25 basis points or 0.5% or 0.75%, that tells the business owner, oh, I can use less capital to grow production at my company. I can borrow money to create more opportunity, to hire more employees. That is positive for the business owners. That is severely negative for savers. That is severely negative for anybody out there who wants a risk-free return, because as he brings the Fed fund rate down, which right now it sits between 3.5 and 3.75, the 10-year Treasury sits around 4%. As he begins, the new Fed chairman begins to lower interest rates, that means that these risk-free investments are going to get worse and worse for people who haven't bought into them already. So that's important to understand as you're looking at your portfolio. Do I want to keep 100% of my portfolio in risky investment? It's paid off. Don't get me wrong. I mean, if you've been in growth mode, you could have been seeing 15+% returns year after year after year. Yeah. And I think that's going to continue for some time, but eventually it'll stop. Something bad will happen in the economy. The markets will tank. And if you don't have safety inside your portfolio, you're going to do something rash. If you don't have a good advisor, a good planner, you may do something rash. And I've seen it happen. Clients have called me over the last 3 or 4 years during these volatile years. Joe, should we be selling out? Joe, should we be getting out? Should we be moving out of the stock market? And every time I'm saying, we've built your portfolio to withstand these ups and downs. We've constructed a plan to weather all of these storms. That's what a good financial planner does for you. You know, I can't tell you whether the stock market's going to go up or going to go down on any given day. You know, I don't know. But I know my clients' portfolios will be okay, whether it does either one of those.
Okay, we have the book up. I want to change to this because you said something that kind of clicked with me. What's my risk? Do I have stuff in risk-free investment? He's built a quiz for you to figure out where you are. Everythingriskquiz.com. You can scan this as well. You can go back if you're recording this, which you should be doing, or you can go back and find the scan for the book.
Well, and we have this on YouTube.
And you have this on YouTube. So
you can watch it again and again.
Always go back, but scan the QR code for this. Everythingriskquiz.com. So you said something. If I want risk-free money before I get a new Fed chair and I'm in an optimum time to use the interest rates that exist right now for risk-free, explain what that means. And people will go to say, everythingriskquiz.com. This gives you an idea of where you are risk-wise, how you feel, where your money is, what kind of risk are you taking, does it match the portfolio? Give me an idea.
Well, without getting into product specifics, because that's not what we want to talk about this show. We're not pitching products on this show. We're going to talk about generalities, okay? There are fixed investments that the rate of return on those fixed investments are tied directly to the 10-year Treasury.
Okay.
The 10-year Treasury is tied directly to the Fed funds rate.
Yep.
And the Fed funds rate is run by the Fed. And we know that Powell has lowered interest rates 3 times in 2025. We know that Trump is looking to put in a new Fed chairman, and that chairman or chairwoman, it's 2 men right now, but it could be a woman, that individual will push rates even lower. So we can see the future. We don't always get this, but we can see the future. So we know fixed rates are going to start to come down. There are investments that you can purchase inside your portfolio that are tied to bonds. You can purchase those investments. Those investments will purchase bonds that are at a higher rate today that will help lock in those higher rates inside that fixed investment for maybe the next 5 to 10 years. So if you haven't looked at fixed investments, if you haven't looked at de-risking your portfolio, now's the time to look at it, because 3 years ago, I wasn't offering these solutions because interest rates were so low and they, frankly,
didn't make sense.
They sucked.
Yeah.
That's a very technical term, by the way. So if you don't understand that, you can look it up.
That term. You look it up.
They were awful, and they're really strong right now. And I have a feeling that in 5 years, they're gonna kind of maybe suck again. And so we have this opportunity. We have this time right now. We can see the future. We know 2 things are happening right now. Interest rates are high and they're going to go lower. Tax rates are low and they're going to maybe go higher. So we have this chance to do financial planning. Not just sit down with an advisor who's going to sling products at you, someone who's a one-trick pony, who's just going to sell you something, but build a financial plan, which we will do for you. We'll build a free financial plan for you where we will look at taxes and risk. We'll look at your tax allocation and your risk allocation, and we'll make sure that you're not taking too much risk in your portfolio. We want a risk level commensurate to what returns you need in the portfolio. And we want to make sure we create a portfolio that has some de-risked investments. My clients right now in those risk-free investments are getting double-digit returns, Brad. To be able to get 10,
Risk-free.
11% returns with no fees, and no risk, knowing that once they get that return that's locked in, they can't ever lose it. Those investments are not going to be at that level for much longer, especially if we get a Fed chair in there and they start to aggressively lower interest rates. We will lose this opportunity. So if you're looking at your portfolio and you go, oh, all of my money's sitting in Vanguard, all of my money's sitting in Fidelity, that means your money's at risk, right? Because markets can do what every day?
Go up and down.
They go up and down. And they may not always go up. They could have a down. We could hit a bear market where we start to see these markets go down. But if you have that risk portion of your portfolio, that risk-free portion, you don't have to worry about it. You're safe. Which allows you at the same time, what's really interesting is the more risk-off investments you have, the more risky you can be with your risk investments.
Yeah.
Which is just, it's nice. It gives you the opportunity to make more. You know, I'm from a farm state. I love farm saying, fences make good neighbors, pigs get fed, hogs get slaughtered. My favorite one though, when it comes to this is make hay when the sun shines. And the sun's shining right now, and you can make hay in risky investments and in risk-off investments.
So what is your risk situation? When you find that out, then you want to make the phone call to 844-403-2275. Why? Because maybe you have an advisor that hasn't talked to you about any of these things, about whether or not you're making hay while the sun shines, and whether or not you have growth, and whether or not you have risk-free investments. It is a plan because it's multifaceted, and maybe you just need a second opinion on how to figure that out. That's what Joe does. That's what we do at Sequinox Wealth Management, 844-403-2275. Put together a plan because it can get complicated. And we've talked about it in previous shows. Is there logic to what the government's going to do? Very little. Do we know that they're going to change their minds and change the rules? You bet. So why don't you work with the rules that you know now? 844-403-2275. We're back after this.
Got out of high school and I went directly in the Army. So I spent 4 years in intelligence as a Korean translator. When I got out, I wasn't sure what I wanted to do. Met a friend of my spouse at the time who was in finance and just said, I think you'd do well in this. You know, at the time I was kind of lost, didn't know what I wanted to do. I was driving truck, 21 years old, and just trying to figure out life and what's gonna happen. I had a wife and a kid and I just needed to do something. This opportunity came along, but I didn't think it was for me. And so I kind of passed on it. But I'll never forget one day I was in the truck and it was the summer and it was hot. And I was just fed up with what I was doing. And there was a guy in front of me, I can still picture him today. He was in a Jaguar, he had the top down, and it just looked like he was having the time of his life. And I was miserable. And I just said, I'm not doing this anymore. I'm gonna find something that I'm good at, that I love, and I think I'm gonna try this. Financial services, you know, financial planning. And I really love teaching other people. So to be able to have a career where I get to meet with people, I get to talk to them, I get to help them solve their problems, I've really enjoyed it. I love what I do. I wouldn't want to do anything else. And it's been almost 30 years and I'm hoping for maybe another 30 more.
Glad you're with us on Everything They Never Told You. Brad Johansen, Joe Wirbick, President, CFP, Sequinox Wealth Management. We're talking about change. It's the only thing constant. And now we're going to get this in 2026 with the Fed. We talked about having a new Fed chair. What's the timing on this? Are we April?
April. We should get the new chairman in April. And then that's a 4-year commitment. So that individual, you know, we have 3 systems of government, right? Mm-hmm. Can you name the 3 systems? Am I putting you on?
Legislative,
judicial, and executive.
And the executive branch, which is where everybody seems to think the power is, and yet it's not.
It's not. I think there should be a 4th branch, and it should be the Fed. And the Fed has more control over what you can buy, how much of it you can purchase, what your retirement looks like, what your bills look like. And this is an individual that's not even voted into office. This is an appointed position. So we, the people, don't even have control over who goes into this position. And their job, they have two jobs, okay? I know that the current president wants to think that their job is to make the stock market go up. It's not. The Fed has two mandates. That's it. Maximum employment and price stability. That's the only reason they exist. Their only job is to make sure, does everybody who wants a job have a job?
Yeah.
And is our dollar being eroded too quickly, and are the costs of goods and services too high? And so they have one tool to manage those two mandates. And the only tool they have is the Fed funds rate. And they can raise the rate or they can lower the rate, okay? Right now, they're in a position where they are talking about lowering the rate because it will do two things. Number one, it'll make the cost to borrow money less, because if interest rates are lower, businesses can borrow money at a lower rate, which means those businesses now can expand their factories, they can hire more people, and that would take our unemployment rate, which currently is sitting at 4.6%, which is kind of high, and is maybe not maximum employment, which tells me the Fed should continue to lower interest rates to get to that maximum
But it's not
employment.
just businesses who want this, it's people who want to buy housing right now.
We were going to get there, 100%. So as the Fed lowers rates, in turn, that means that the 10-year Treasury should come down, and then your mortgage rate is tied directly to the 10-year Treasury. Your mortgage rate should be about 1 to 1.5% higher than the 10-year Treasury, which is interesting because the 10-year Treasury is at 4% and mortgages right now are sitting above 6%.
Yeah.
So banks are being greedy little bleepity bleeps. I won't put in that right now.
But
banks are being rather greedy, and mortgage rates should be lower. So I think with the new Fed chair, we'll see increased lower Fed funds rate, which will bring the 10-year Treasury down, which will bring mortgage rates down, which will make it more affordable to buy a house. In return, it will cause more people who've been locked in to that interest rate. So people back 5-6 years ago could get a mortgage rate at 2-3%, and they've been locked in. So they haven't wanted to sell their house and go to those 6-7% mortgage rates.
Exactly.
As that rate comes down in the mid 5s, which I think we'll see that maybe into the upper 4s, depending on how aggressive this new Fed chair is, that's going to free up people to want to sell their house to buy a different house. And that's going to put more inventory, but then there's going to be more demand because people who've been sitting on the sidelines who haven't been able to afford a house will now have the opportunity because interest rates will be lower. It's a convoluted mess, but I think at the end of the day, it'll be positive for business and mortgages. It'll be very negative for your savings because your CDs, your certificates of deposit, those are tied to the Fed funds rate, and those are going to come down. Your money market accounts, where you've been able to get a 4.5%, maybe a 5% risk-free rate, those are going to come down. And right now, you know how much money we have in money market accounts, Brad? How much money is sitting in money? Before COVID, there was about $2 trillion.
Okay. There now is
$7.2 trillion sitting in money market accounts.
Is it because of people's fear or because of where the interest rates have been, or a combination of both?
I think it has everything to do with higher interest rates.
Okay.
If inflation's at 2.5% to 3% and money market accounts are yielding 4.5%, it's a no-brainer if you want to park cash. Hey, I'm getting higher than inflation and I'm taking no risk. But it's going to be interesting to see what happens with that money as money market accounts fall. As the new Fed chairman lowers interest rates, in effect, it's going to lower CDs, it's going to lower money market accounts. That $7 trillion has to go somewhere. It doesn't mean that all of it's going to come out and go somewhere, but I think it's going to come out and go into the stock market, businesses, and real estate. And what does that do? That drives up the price of homes, that makes unemployment lower, and that drives up your retirement. So all positives for this volatile year that we could have in 2026. I think it's going to be positive. I think we're going to see the stock market continue to rise. The other thing to think about, now this is historics, Brad. Now this is not guaranteed. Okay. And I hate using these, but it's still a fun one to look at. Historically speaking, every time the Fed lowers interest rates, every time we see an interest rate reduction, the post 12-month return in the S&P 500 on average is around 13%. Unless that interest rate reduction occurs outside of a recession. We're not in a recession right now.
Not in a recession.
So that means that outside of a recession, interest rates go down. Historically speaking, the S&P gains 18% 12 months post interest rate reduction. We just saw the first rate reduction was December of 2024. The S&P returned almost a 17% return for 2025.
Yeah.
Just saying, pretty close to that 18% average. So we just saw Fed lower rates this December, November. That means we could see another 13 to 17% gain in the S&P 500. Not saying it's definitely going to happen, but it looks positive. So if you are invested in the stock market, this could be a good chance for you to see, especially if the Fed continues to lower interest rates. So these are all things you have to be thinking about. You have to understand who's the Fed chairman, what are they doing to interest rates, how does that affect your risk money and your risk-free money, or you could keep it simple and you could hire us. Let us worry about this for you. Let us handle this. Our average client pays less than 1% in fees for us to do everything that we do for them. Build financial plans, do Roth conversions, give them the income they need in retirement, create generational wealth for them, give them that just knowledge that they don't have to worry about the ups and downs of the stock market because Joe and his team have it taken care of for them. You can dial that number. You can scan that QR code. You can sit down with us. We can build a financial plan for you, no cost, build you that plan and show you how we can take over your retirement and just let you sleep a little better.
Don't you want it easy? I mean, that's the idea. 844-403-2275 for a complimentary written financial plan. After you've gone to the risk, and maybe you want the book as well, that will be for free. The idea is to make retirement simple because the government tries to complicate it as much as they can, and your number isn't your number. The government wants a piece of all of it. 844-403-2275. Let's put together a plan for you. More to talk about. Everything they never told you, we will after this.
When I'm going to hire a new advisor or a new staff member, I want them to be open-minded. I want them to be able to have their own ideas, their own opinions, but be able to listen to new ideas. When I mean new ideas, I mean we're going to change course with our clients multiple times throughout our tenure with them. The plans we build are going to change. The economy is going to change. Tax laws are going to change. Everything is going to change. And so we have to adapt with that. And what we recommended 5 years ago may not be the right solution today. So we have to pivot. And they have to be okay with that and do it because it's the right thing for the client. It takes work. A lot of advisors build portfolios and they sit back on the golf course and they meet with their clients, a few times a year and talk about returns. And that's not what an advisor should do. An advisor should be in the trenches with their client. They should be constantly questioning their recommendations and coming up with new ideas because the world is changing more rapidly than I think we're even aware of today.
Take advantage of what you can while it's there. Brad Johansen with Joe Wirbick, Sequinox Wealth Management. We're talking about the Feds and things potentially changing in a major way in April with a new Fed chair. I want to put the book back up as well for you because a lot of you want this for free. Okay, we'll give it to you for free. Scan the QR code. Joe will send it out to you. It is everything that they never told you about retirement. I'll leave that up but we kind of have to wrap this up. So I want to circle back. Time is ripe right now before April for what?
I like to protect my clients' assets. And the two biggest mistakes people can make in retirement, being too risky or being too conservative. And right now, I think that most people are more on the side of being too risky in their portfolio because the stock market has done so well for so long. Because they're making so much money. We're seeing millionaires every single day being created inside 401ks because we're seeing these 12, 15, 18% returns in these mutual funds, and it's driving their portfolio higher. But they have to realize that eventually we will have a reset. Eventually the markets will turn and we will have a bear market. What you don't want to have happen is that occurs the year you retire and you're taking too much money out of that risky portfolio. So right now, January to April, interest rates should stay level. Now's the time to look at that portfolio, take that risk quiz, see am I taking too much risk inside my portfolio, and take advantage of these risk-free investments that we can look at your portfolio and say, okay, 70% risk, 30% safety, 60% risk, 40% safety. I've been able to average roughly 9 to 10% returns with my clients with a 60-40 blend. Because we have these investments that are kicking off these high rate of returns. And if you get in those investments now, that could be locked in for 5 or 10 years as interest rates are going down. As everybody else who gets in 3 or 4 years from now, they're too late. You're standing in line at the club. You're getting close to the door. You don't want that door to shut and tell you, sorry, it's too full. You waited hours and you never got in there. Yeah. You want to get in on these great rates while they're still around, but you have to realize there's a problem first. And this isn't me lowering the lifeboats, telling everybody, hey, there's market turmoil, get in the lifeboats, I'll protect you. This is me saying, hey, I'm lowering the lifeboats. It's time to get some risk-free investments before it's too late, before the Fed lowers rates too far, and I won't be able to offer these to you because it won't make sense anymore because the rates will be too poor.
Well, I think your quote was because they're going to suck again. Right?
Yeah. That is a technical term I like to use. I think I learned that when I got my CFP. That was one of the words they taught us,
Timing matters, and everybody wants to time the market. Nobody can figure out how to time the market, but when we know what the rules are, the way they are, that's your timing, because it's going to change.
Without a doubt, we know it's going to change. And it's not about timing the market to be selling and buying on a daily basis. We're not talking about day trading. We're talking about timing the interest rate market. Yeah. And it's written on the wall. We see it. Interest rates will be going down. We are going to be losing our current Fed chairman. We're going to be getting a new Fed chairman. Trump is going to put somebody in place who will lower interest rates. So I can tell you with pretty much certainty that over the next year, we'll see interest rates come down, which means those risk-free investments will not be as profitable at the end of the year as they are at the beginning of the year. So there's a limited window of opportunity. Act now. Check out your portfolio. Are you too risky? And wouldn't you like to have some risk-free investments that are kicking off potentially double-digit returns with no risk to the downside and no fee? Get that plan, let us show you, and more importantly, check back with us next week.